What do you think about where we are now? Are we set up for a bounce? Are we oversold? Can we get something going, at least for the near term?
I think that we haven't encountered all the negative catalysts that I foresaw at the summer rally, Scott. So on the one hand, while there's no argument at this point that there's no Fed pivot forthcoming, right, which is one of the underlying reasons for the rally, there's two negative catalysts out there that we haven't quite digested yet. The first is that, while we agree that the Fed hasn't pivoted, I'm not sure that there's agreement on what's going to happen in November and December. And, if you believe them that we need a 4%, 4.5% rate, that implies another 75 basis points or 50 basis points in November and something similar in December. I don't think that that's quite in the numbers yet. The other thing that I think we have not yet encountered is the negative revisions. While it has
earnings.
That's earnings, right? Well, it has started to some degree. In the first 2 months of the third quarter, we've seen them come down about 5.5%, which is twice the historical average. But when you look at the fourth quarter, we're sitting at 60. I believe that's 10 to 15% too high. When you look at 2023, which we'll all likely turn to, I believe that that's 10 to 15% too high.
Wow, because growth projections for earnings next year are 8%. So, the jury's out. Let's take one at a time, okay? Because I have my fact set pulled up right in front of me here.
Right.
And I'm squarely looking at the 10-year, okay, at basically we'll call it 398, all right? 2 basis points away from 4%. As long as rates continue to go up, can stocks get out of the way of that or not?
I don't think so. And I'm going to invite you to look at the other end of the curve. At the end of the day, the 1 year's yielding 4.15% right now. Why would you buy equities in an uncertain environment in terms of interest rates, in terms of QT, in terms of earnings growth, when you can get a guaranteed 4.15% on a 1 year?
Okay, so you're in that there's a better game in town.
There's a better game in town, and that's investment-grade credit and other instruments right now. You're not being compensated for the risks that equities pose.
Now, if rates stable, it's not just rates, too. It's I could pull up the dollar, and I would say, man, that's been off to the races, too.
Right.
And therein lies sort of the two-headed problem, right? You've got interest rates going up, you've got the dollar going up, and all the obvious issues that are related to that.
Right.
But as long as that doesn't stabilize, if you want to use that word, stocks can't stabilize, or can they? Even in the near term. Let's not look out 6 months from now. Let's try and look out 6 days. I think people need some sort of direction on where all this is going.
I think stocks can stabilize if we see two things. The first is we need to see those negative revisions behind us. And maybe I'm wrong. Maybe that we will have a soft landing. Maybe the economy will bounce back quicker than we expected. But from where I sit, another 150, 200 basis points of Fed raises unemployment, slows growth in the economy, and the earnings aren't reflecting that yet. And so we can't have a rebound in stocks until we have reliable earnings, and we can't have reliable multiples until we have reliable earnings. So saying something is cheap on multiples that are inflated for 2023 is a fool's errand.
Well,
right?
you imply then there's a gray area that's going to exist for months until we have clarity on all of those issues. We have to wait around for all of that to happen before we can get some sort of bottoming in the market?
I've been waiting for that since January. That is exactly the problem, is that we have estimates and predictions that are all over the place. There's no common or shared reality in terms of where we are.
So the other issue, and I frankly think it's the biggest issue, is this debate over whether the Fed's done too much. Because it leads to where bond yields and currencies are going, and like dislocations that you see in the UK bond market, right? The certain policies that they've done there, but more specifically here at home, whether the Fed's done too much. And you've heard the debate, and it's escalated of late. Jeremy Siegel was obviously louder than most in terms of where he came down on that issue. What about you? What do you think?
I don't think that they've done too much. I think that they've done it too late. There was a small minority of us who were saying last year that they needed to come out of Jackson Hole into what we knew was going to be a blockbuster third quarter and start raising rates in 2021. That would have prevented the need for draconian measures this year. Now, at the end of the day, they haven't moved their mandate. Others, like you said, have suggested even moving the goalposts, that maybe the target rate shouldn't be 2% on inflation. Maybe it should be higher. But at the end of the day, they've rejected that, and they said that they're going to stick to this mandate, which means that they haven't done enough to reach it because we haven't seen any meaningful impact yet on the inflationary numbers, especially the core numbers.
But too late is not so different than too much. The whole they were late, which is why they've had to raise a lot.
That's exactly right.
And fast at that, right? You do 375s back to back to back. That shows you how late they were in terms of getting in front of, or at least trying to get in front of. It's interesting. We had, our Delivering Alpha event is tomorrow.
Yeah,
in person for the first time in 3 years. Buy your tickets. Now that you're here in town, you have no excuse. So we did a survey of investors leading into that. Okay, is the Fed moving too fast on rates? 35% said yeah. What's your biggest concern for the markets right now of all the issues on the table? China, Taiwan, no. European energy shortage, no. Midterm elections, no. Job market in the U.S., no. 58% Fed's too aggressive.
Right. And I think that they've done a pretty good job. And when
the Fed?
I think they've done a pretty good job of telegraphing that there will be pain associated with this and that they're aware of that. And so when I think people say that the Fed has done too much or the Fed is moving too fast, it doesn't recognize that they were slow to the table and that they essentially don't have a choice. But it is also a rejection of the economic pain and the slowing of the economy that we know necessarily has to accompany the actions that they're taking.